So what I wanted to go over today, guys, is introduction to business combinations. So we're sort of getting ourselves into the process of combining, of merging two businesses, right? Before we talked about the equity method of investment, right? And the equity method of investment, in a way, what kind of interaction is that, guys? Who can explain to me the equity method? Is it a business combination, merger, or? Exactly. In a way, the answer was, guys, that it's how we invest and how much we allocate based on our investment. So in a way, the equity method, the purpose of the equity method was to show us how you interact with an investee company once you own a section of it. That was really the purpose, is to show you, okay, if I have an investee company, I'm going to interact with it. I am going to have a relationship, right? Which is really intro to what happens on the business end, on the books and records end, if you buy the whole company outright. Because most of the time, when we talk M&A, mergers and acquisitions, you go and you buy the whole company, right? You go in and you just acquire a company. And that's sort of what we're starting to get into for the rest of September, is not only what do you do when you acquire the company, but what kind of accounting treatment do you have to do to maintain the books of this relationship. And that's where some of these nuances and complexities come up in these situations. So this is going to be going over some numbers and some charts that I put up on Blackboard, slides for the lesson plan. But before we get into that, what I want to go over is another part of what's going on here that's not so visible in the book or the slides. What I want to go over is the other side of the transaction of what we're doing from a finance standpoint. What happens from a finance? This is more like books and records, accounting, journal, accounting system. Now, this is, I want to give you guys a background of something that happens more on the banking side. So with this, I want to go over this chart here. For example, say Visa is getting acquired, right? And it has three different companies that are trying to acquire it. JP Morgan Chase, a private equity firm, and MasterCard. And the first point is that most acquisitions are not hostile type takeovers. It's mostly Visa wants to get acquired, right? So Visa hires a banker, hires a lawyer, and for months plans a way to get acquired, right? So that's sort of a voluntary situation that they're going through. Now, why would a company want to get acquired? This Visa recently went through this, no? In a way, not exactly, but in a way. Why do you want to get acquired? If you're very fortunate and one of the family members of Visa, family that owns Visa, why would you want to, yeah? Maximize shareholders' value. In a way, you are the shareholder, right? If you're the family, it was a family-owned company up until not too long ago. Cheaper cost of financing, in a way, being a public company versus private. Sometimes they say it's cheaper returns because the financing is diversified. It's a little finance theory, but not. I'm looking for something a lot simpler. Yeah, exactly. You want to get paid, guys. If you ever owned a private business, right? The thing is about running a business is great. It's great. Even successful business is great, but most of the time, those people, they don't have a lot of money because their money is very tied up in assets, right? It's not cash that they have. They have as equity, Look at, for example, Facebook. For a long time, you know, there was equity, but there was no cash, you know. There was no money. Nobody was getting paid. So same thing like this, you know, yeah, we were making money, but we didn't have capital. The distinction between cash flows and capital, guys, is that Visa cash flows are maybe like $1 billion a year, but the Visa value is $100 billion or something like that. So it's different if you're the family of Visa, whether you get $1 billion a year or whether somebody gives you a check for $100 billion right now. And that's called cashing out, right? You want to cash out, you want to get some liquidity for the asset that you have. And what did Visa do? They could have gone this route of selling, you know, selling to a firm, you know, but they went public. They went public like 3-4 years ago, you know, and that's another way of getting liquidity, is that you just offer your shares to the public. So what's the idea of what's going on in this? This is a transaction. So the idea is, the second piece of this is there are 3 types of firms that are trying to acquire. JP Morgan Chase, which is a bank, right? It's a bank that also does credit cards. So it's a bank, and it would get Visa. What would JP Morgan Chase do with Visa? Anybody would know? Would they want an asset like that? Would they like having something like that? Yeah, why not? Very nice, no? But the question is, what would they do with it? There are 2 things that they would do with it, no? Yeah. Yeah. So you sort of a strategic kind of bond, right? It would be more of a strategic bond. And I'm also seeing, since they're also bankers, JP Morgan, you know, there's the Chase part, commercial banking, there's the Morgan, you know, there's the aspect of the investment banking where they may want to do something with Visa and, you know, sort of tune it up and then sell it, you know, and IPO it. You know what I mean? And make that $20 billion on just financial engineering, which is what a lot of people do with. That's a great asset with Visa. I think anybody who does some magic to it can get money out of an asset like that because it was so clean, right? It was such a clean balance sheet on that company. So, but what about a private equity firm like KKR? You know, private equity firms. What do they like to do with assets like that? Anybody know? Anybody into finance? So that's more like, okay, we'll take the company, you know, we'll put some debt on it, we'll try to improve its board management, connect it with all these powerful people that are in our network, maybe politically connect it, do things to it that are good, increase its cash flows, and then IPO it. Because private equity firms specialize in financial engineering. So a company like Visa, its management is not as fluent in financial engineering as like a KKR, a private equity firm. 600 financial experts versus people who do business. So private equity firms, they're financial engineers and they know industry really well and they mix it all together. So if a KKR owns Visa, they'll do things to it knowing what the public wants to see, and they'll make the numbers look better. And the IPO will generate value that way. So it's just another way. And then MasterCard, if MasterCard acquired Visa, that's non-financial, it's purely strategic. In a way, they want to eliminate competition, get market share, leverage technology, decrease shared costs, create brand synergy, whatever, economies of scale. So this is sort of that landscape, and the way this transaction would happen is that each of the potential acquirers would submit bids, and the bids go to the bank. They don't necessarily go to the company. Visa takes itself out of the equation and has Goldman, in this case, Goldman Sachs, deal with all the sort of financial stuff. We're like, we don't know, we don't care, we make cards, we don't know about this stuff. Goldman does, and Goldman is really good at it. They will basically pump up the price of this company by generating competition. What they'll do is they'll market the hell out of this company by calling every hedge fund, every private equity firm, and they'll go to MasterCard, and they'll go to Discover, they'll go to Amex, and they'll say, I'm selling this hot asset. It's got amazing returns. It's the hottest assets and whatever. And you can acquire it now. We can get you exposure. You're the only person we're pitching it to. And that way, they'll generate this high level of interest by marketing this asset. And then the bids will start coming in, and then they'll kind of like angle everybody against each other. Be like, well, this one is paying that, and this one's paying this. And then sort of try to get that bidding war. And what happens to the price of Visa in the meantime? Say it was a public company. What happens to the price of Visa while all this is going on? It goes up. It goes up in a way. So I remember that when I used to work in auditing, some of my friends worked on transactions, and they weren't allowed to tell you what transaction they were working on. You could be hanging out with them. Oh, what are you working on? Oh, I can't tell you. Because there's, it's non-public information. If it gets leaked, right? If it gets leaked, then that hedge fund that you would call to let them know, they can get a big position in that company, and and that's called non-public information. Non-public. I remember when I used to work at the hedge fund, in a way, a lot of people were working on getting, not in a way non-legally, getting this kind of non-public information, but there was a lot of people sort of speculating non-stop about who's getting acquired. That was a big part of like equity research, is just like figuring out which rumor is correct in terms of the potential acquisition, because that acquisition premium is usually 20-30%. So if you get on the wave of that, easy money, just from a technical trading perspective. So, any questions on this, guys? For you guys, I remember some of you guys said you're interested in finance, or you're interested in sort of more in that sort of banking kind of thing. This is like the other side of what we're doing, not really visible from what we're doing, because we're dealing with more in the accounting world subsequent to the transaction, after the transaction occurs. This all happens before the transaction occurs, in a way. Any question? Anybody have experience or questions or anything to share? Good? So what I wanted to go over, I want to start going over chapter 2 here, which is all about acquisitions. And there are two types of acquisitions. There's the acquisition method when dissolution takes place, and then there's the acquisition method when dissolution doesn't take place, when the acquiree company continues to exist regardless of the acquirer. Basically just remains a legal entity. The first one we're going to go over is when the company it gets dissolved on the date of acquisition. And the easy thing about that is that when the company gets dissolved on the date of acquisition, all you do is you bring over the acquiree's assets onto your balance sheet at their fair value. That's it. So in a way, if Visa was to get acquired and dissolved at the same time, then say MasterCard bought it, all MasterCard is doing is taking the Visa balance sheet, putting it on its balance sheet, and that's it, it's over. As opposed to if it said, you know what, let Visa exist, we'll control it, but we won't publish it, it's just going to be like a quiet thing, which some companies do. Then, first, you keep the brand, you can keep the brand, not dissolve the brand, right? And then it's quiet, it's in the background, it's just running, the fact that you own it. And then every year you do sort of a mock consolidation because the company keeps running. You don't dissolve it. As opposed to, if you do dissolve it, that's it. Visa is gone. There's no more Visa. Its assets are over on your balance sheet. And now, all you do, it's a one-time kind of thing. So it's, in a way, the solution is much easier, like operationally. So, how do we do this technically? How do we do this technically? Is we look at the acquiree company financials. So we have Calico acquires Malibu Inc. and the legal status of Malibu Inc. is dissolved. And we're looking now at the financial info of the companies, and we want to look at be like, okay, so this is the book value of the balance sheet, right? Total assets are 1.2 million, total equity is 1.2 million. Now we also want to examine the fair value, right? So we see the fair value of the assets is 1.4, the fair value of the equity is 1.4 million. This is the balance sheet of Calico, the company that's doing the acquiring, and you see it's 2.5 million, in a way irrelevant except for the accounts that we're going to be using. This is the journal entry we're using to combine the companies. In a way, it's a one-shot deal. This is your journal entry we're doing right now, and this is the combination journal entry. What are we doing? Basically, we're debiting the assets for the amounts, the applicable amounts of their fair value over from Malibu, right, to bring them over to Cali. That's all we're doing. Because if you debit each asset, right, don't you actually have the whole company? Yeah, I debited the assets, and now I have the company on my books. The other piece of it is this piece that is called consideration. What's consideration, guys? What do you guys think? What is the payment amount, right, in assets, the legal consideration, right? And how much are we paying in this case, guys? 1.4, right, Peter? 1.4? So 1.4 million, and is it broken up into two pieces? What are the two pieces, guys? Cash and equity. How much cash are we using? Yeah, so we're paying 500 in cash, 900 in equity. So what's the idea in paying in equity, guys? Who can describe to me, like, what does it mean? A lot of times you read the news regarding the acquisition. MasterCard bought Visa using $4 billion in cash and $12 billion in stock. In a way, so it's a pretty complicated concept, guys. In a way, these companies that are acquiring the Visa, let's say Visa's price tag is $30 billion. Is it easy to just come up with extra $30 billion in money? I mean, it's going to take a little time, no? So, even for heavy companies, like $30 billion in additional assets, it's going to take a little minute to figure that out. So, how do these companies come up with $30 billion? There's a financing piece involved. Because usually companies don't have that around. You don't have unless you're like a Microsoft or an Apple. You don't have like $30 billion in cash laying around. How do you come up with that money? One way is you issue equity. You issue equity right away to pay for this acquisition. And what does it mean to issue equity? To issue equity is basically, I'm talking about a non-IPO, which is called technically a secondary market issuance, which is any company can do this. At any point, any company can go to the market and issue equity, right? If Apple tomorrow went into the market and said, we need $2 billion, would they get it? They would get it right away, right? The Blockbuster a few years ago went into the market and asked for $2 billion in equity. Would they get it? No, right? So the idea is equity is very easy to see if you're going to get it or not, right? Because it's an indication of whether people think your stock is going to go up or not. That's basically what it is. It's more shares in the market that you're putting out there. If nobody wants it, nobody wants it. People want it, then you're going to get it. So when MasterCard say paying for Visa 10 billion cash, 20 billion stock. What does that mean? Whose stock? MasterCard stock. MasterCard is going to go to its shareholders and say, listen, we have a great idea. We're going to buy Visa. Can we get $20 billion? The shareholders would say, you know what? That is a great idea. Here's $20 billion. You got it. So then they're gonna get the cash basically, right? And in a way, this issued stock, they can pay with that stock to Visa. What they do is they pay using stock. They're like, listen, we have MasterCard shares. Can we give it to you? And they give it to them. That's what we mean by payment in stock. It's like MasterCard giving shares to Visa. In this case, say it's the Visa family. They're like, we'll give you MasterCard shares. Anybody know the drawback in getting paid in shares rather than cash? Anybody have an issue like that? If you have an issue like that, you're in good shape. Yeah. That's one issue, is the stock goes down. That's sort of my secondary concern, but definitely is a risk. There's a risk there, but there's a higher concern, and related to that is a higher concern. You have to wait until you have to unload all the shares. And in a way, I remember this. I remember I used to work in a hedge fund. Used to own this company, VitaCost, about 5%, small internet vitamin seller. And I remember doing some liquidity analysis on it, and I remember realizing that it would take us about 30 days of trading to sell our position in VitaCost, because the volume was not that high, and we owned so much of it that I was like, the risk was, if anything ever happens to the company, we cannot sell it. Because if we start trading it, and I've seen this with small companies, when you're trading small companies, you're influencing the price. Because if you put in a big order, people start seeing your order in the market, and they know that price is going to go down. So people start getting involved in the market, knowing that you're selling, start giving you lower bids, push the price down. So in a way, say you own a big stake of a company, it may take you a year, 2 years to unload it, because you cannot put something in the market and pressure it like that, because the market is only as liquid as how much trading there is. If you're trying to trade 30% of the company, it's going to take some time. So that's a restriction. And then during that year, the stock might go down or up, right? So in a way, what people do often is they get the stock or whatever, but then they use options to hedge, so you don't get the downside. But anyway, so that's the idea of how something like this would happen, is you would actually do part equity, part cash, right? So coming back to this, with the 1.4 million of the stuff that we're acquiring, some of it is cash, some of it is stock. And in a way, how much stock did we issue here? We issued 20,000 shares. We issued 20,000 shares at 45. And we raised 900,000. Basically went to the market. You know, if your stock is trading at 45, odds are if you go and issue it, it'll be like about that price that you issue it at. That's how much money you would get, or shares that you would get. And that's the effect of what's going on here. This is also, I wanted just to note, this is also an opportunity for you guys to sort of share, present, like what I meant last week in terms of case study or presentation. This is like sort of part of, I plan on doing this all fall, is go through problems. Pretty much about half the time we'll be here is I'll be going through problems. So in a way, I would love for you to sort of participate this way, and maybe keep in mind when you're doing the homework that, you know, that's in a way I want you guys to share what you guys got during the week out of this experience, and share it with the group. Maybe you had a different way of doing it. Maybe, you know, there's actually a lot of different ways of doing these problems. Most of them, you'll notice, a lot of you guys is sort of you figure out a trick on how to do it, and then if you know the trick, you always know the trick. So if you guys share those with me, I'd really appreciate it. And with the class too, help people figure out the shortcuts of how to do this. So we'll start with number 3. We'll start with number 3 here. This company, Pacer Company, paid $1.92 million for 60,000 shares of Len & Co. voting common stock, which represents a 45% investment. There was no goodwill. A significant influence over Lenin was achieved by this acquisition, and Lenin distributed a dividend of 2.5 per share during 2013 and reported a net income of 670,000. What was the balance in the investment in Lenin Co. account found in the financial records of Pacer as of December 2013? So, in a way, how would we do this, guys? What do you guys have any specific idea? Who? In the way, you're almost there, and I appreciate you sharing that. But if we apply this piece, and you had it everything up until here. If we apply this piece, what we get is the 2,071,500, right? So that's something that we end up getting. And I like what, in terms of the point that you made in regards to dividends, I wanted to go over that a little bit. Because the idea is, if we're looking at a company, the acquiring company is paying a dividend. How much of that dividend do we actually get, right? How much is it's sort of a capital structure kind of question, right? And the dividend that we're entitled to always relates to the percentage of the company that we own, right? So if we own 30% of the company, we get 30% of the dividend. Usually they're telling us the dividend on the company level. They're telling us, oh, we're paying 200 grand as a dividend. To whom? To everybody, right? How much of that are you getting exposure to? The ownership percentage, right? Because you own 30% of the company. In every question except for this one. In this one, they actually gave us your shares and the dividend per share, which puts us a little bit in that realm of like, shares times the dollar per share. But, so in this case, we get this number, but usually if we had a 30%, I would take 30% of the total dividend and I would apply that as my return of capital. Right? So now, moving on to, yeah. Yeah.
Is that this way you're supposed to write it out to get that answer?
There's really no right way, I would say, to do this. It's not that way.
Yeah, I would tell her, I was saying she shouldn't copy that way.
Yeah, I would say you would do it the way that you like to do it best. The way that you like to do it best.
I think she's asking what more how to come up with that.
How did I come up with this number, right? Yeah. Yeah. So the way to do it is, the first piece is we say, what was the investment amount? And that's a positive. That's a positive. And then we say, how much allocation of income did we get from the investee company, right? The 670 comes from here. This is a number, we acquired an asset, right? Say we acquired 30% of Visa there. At the end of the year, what are we we're like, where's the money? We're like, what's the performance? That performance is 670, and we're saying, okay, I own 45% of that, and let me get 45% of that. So far, so good? Then the confusing piece here is like, okay, the 60, which is a dividend, we know reduces your investment account balance because they're paying us money in a way, they're giving us money back. I put in 1.9 million, now they're giving me 150 back, so I should just reduce my investment amount. So I subtract 150,000. So the formula in a way involves, a couple positives, a couple negatives, depending on where you are in that sort of equation. Question number 6 we have here. During January 2012, Wells Inc. acquired 30% of outstanding common stock of Wilton Co. for $1.4 million. This investment gave Wells the ability to exercise significant influence over Wilton. Wilton's assets on that date were recorded at $6.4 million with liabilities of $3 million. Any excess of cost over book value of Wells' investment was attributed to unrecorded patents having a remaining useful life of 10 years. In 2012, Wilton reported net income of $600,000. For 2013, Wilton reported net income of $750,000. Dividends of $200,000 were paid in each of these 2 years. What was the reported balance of Wells' investment in Wilson Co. at December 31, 2013? This way, the $3.4 million is the book value of this company, right? So now, how much of this company are you acquiring? 30%. In a way, look, you're only coming in for a slice, right? And if you were going to say the value of this book, of this slice of this book, the company, in a way, how much? What's the book value of your share? Like, what would be 3.4 times 0.3? Would anybody? Could you help us out? 1,020,000. No, 1,020,000. So, if this is 1,020,000, how much are you providing in terms of payment? Like you said, we're providing 1.4 million. No. So, in a way, before you get to the 38,000, this is in a way 380,000, right? Which divided by 10 gives you the 38. But first, you want to get to that 380,000 in a way, sir. And I want to get back to you, sir. What is the understanding of this 380,000? Like, how do we get it? It's just that I think you got to the right answer somehow, but it's not clear how. Right now, not yet. Not yet. We're just in the process of discovery. We're gonna go through understanding how to get this number. You know what I mean? It's not necessarily how to get the right. It's right now we're just practicing. I appreciate you sharing. In a way, what I want to illustrate is this 380,000 is the excess of over book value, no? And this excess over book value is something that we attribute to the patent. You know, it's something that it says up here, unrecorded patent. So the 380,000, like, I want to first understand it conceptually, is that we're like, okay, that's our excess, and that's something I'm going to put on the patent, because that's where the excess of fair value over book value belongs. That what you do next is you divide this number by 10 and you get 38,000, which is exactly right. In a way, every year I'm going to do this $38,000 expense in my book. It's going to be from 1 to 10. Every year I'm going to book a negative 38. You know, that's just going to be part of what I'm going to do, right? That's in a way with the conclusion we arrive to, right? just, we sort of went through the technical aspect of the accounting. I want to sort of go back again, back into some of the big picture idea of what is it that we're actually doing, and get back to some of this acquisition. This is up on Blackboard now. What we're going to do on Thursday is we're going to go over in more detail in terms of these journal entries. And what I want you guys to do is try to practice the journal entry using this example in the PowerPoint. Try to look at, I'll post out some of the more fresh problems tomorrow. Try to look at them first. Try to read about like how you combine some of these numbers in the textbook. I'll tell you why. I just taught this class in the summer. Some of these chapters, I don't know if I'm just a little silly, but I have to read like 7-8 times because I don't know what it is with the advanced accounting, but it's not intuitive to me. Usually accounting, I can just sort of understand it quickly. It's second time I'm teaching it now. But with these, and sometimes there's 4, 5, sometimes 6 steps to understanding a transaction. What's frustrating is that if you lose the second step and they want you to be in the 6th step, it's like it's over and over again and you're not there. And the idea is first to master just the first step or the second step. And that's what I'm trying to build up with these. Like if you notice in this PowerPoint, if you flip through it on Blackboard, each one of these journal entries goes through doing the acquisition first with no goodwill, then with goodwill, and then with an excess bargain purchase. And then just reflecting to you how this affects the journal entry. And then we go into sort of a business combination where we do not dissolve the entity. And then we work through that journal entry. So in a way, the good thing to do, guys, is, and I know some of you guys are pretty comfortable with this, but some of you guys are, still working with it, is to get used to looking at a full balance sheet and right away understanding what's the net equity. Right away understanding what's the fair value of assets. And then right away understanding, okay, what's the excess of the fair value of assets over the net equity? Bingo. Right now, you're looking at goodwill. Unless there are assets that are valued over the book value. Okay, now you're digging into your goodwill. You're like, okay, there's no goodwill until I mark up my assets. I'm paying extra for the assets. How much extra am I paying for the assets? And that depends, and that's usually given to you. In this case, you see that it's 100. You see that it's 100, 200 extra that you're paying. In a way, for this company to get acquired with no goodwill, you know that you have to pay 1.4 million, right? It's sort of the degree of understanding that I want you guys to get to is when you're looking at a company's fair value of assets and you're looking at a bid coming in, a payment coming in, I want you guys to start correlating and saying, listen, I'm paying for the fair value of assets. If that number matches up exactly, then there's no goodwill. If you're overpaying that number, to that degree that you're overpaying is to that degree you'll record the goodwill. Because you're paying more than it's worth. In a way, you're paying for something that's not visible. And that is the understanding of goodwill, is paying for something that is not visible to the naked eye, even though we already did significant due diligence and have an understanding of asset by asset of what's fair value for everything. Even beyond that, that's goodwill. And that's sort of the clarity that we want to achieve here. And it comes through this picture. I want you guys to understand the reality of the situation where the money is coming in and we're at net equity for whatever the net equity is, and now we're trying to account in the journal of, are we overpaying or are we underpaying? Because now in this merger environment, I want you guys to sort of try to look through the 3 of these journal entries and see the picture is pretty detailed of a perfect payment when you pay the exact fair value, an overpayment, and an underpayment, right? And you want to keep in mind the financing, how it's being bifurcated between equity and cash. How much cash, how much equity you're paying for this asset. How you're raising that money, gives you the quality of your financing. In a way, this is, in the big picture of this, is the quality of your financing. You're a company, you have the money, you do want to make the acquisition, but what's the quality of your financing? Is it cash, which is the best? Is it equity, which is so-so in terms of quality? So this is where we are in terms of these things, the business acquisition. So what I'm going to do next time is I'm going to go over this in more detail and bring a couple more examples, and then we're going to go through and we're going to practice some more to build. It's going to continue to build up one step at a time.